Trying to understand the eminence of real-world assets and the DeFi world? Then you are welcome to Link to the Chain, a podcast brought to you by BSOS. It is designed to help you understand the happenings of decentralized finance along with real-world assets. I am your host, Nikki from BSOS. I will be inviting experts from the Web3 industry to share with you their experiences and ideologies on RWAs and the DeFi world.
I'm pleased to be joined today by Darshan, Vaidya, CEO of Credora. Darshan, please tell us about what Credora is and what you are all trying to achieve in the DeFi space.
Yeah, thanks so much for having me on, Nikki. So Credora is basically a platform for institutional credit, solve the problem of information asymmetry in the space and to try and make credit risk more transparent and the rails around lending to be more seamless, compliant, and institutional friendly. So maybe a little context about why we started this particular business. It was a problem that I myself had as a trader in the space and was initially in traditional markets and then came to crypto early 2018. And as we were scaling out the fund, one of the biggest challenges we had was around proving creditworthiness without necessarily revealing sensitive information about our business. And so what Credora does is help institutional borrowers access capital by validating that creditworthiness in real time, but without revealing any sensitive information to either us or to anyone else. And this basically helps them access more capital at cheaper rates and at scale. And then for lenders, we target generally institutional and accredited lenders. And they're looking to deploy that in a risk managed and compliant way. And obviously, we've seen some of the effects of not being able to do that over the last year or year and a half. And what we're trying to do is give them yield opportunities where it's clear who you face, what's the risk that you're taking on, and quantifying that risk for them, and then giving them the ability to monitor that risk in real time. So that tries to solve the next part of the problem, which is giving them regulatory certainty when they're deploying their assets, whether it's on CeFi yield opportunities or DeFi yield opportunities. So happy to dive into all of that.
Perfect. Yeah, that was a great intro. And it kind of sounds like you were talking about like ZK proof. Is that along the right lines of being able to share sensitive information, but only like particular parts of that sensitive information? Is that kind of a small condensed version of how to explain like zero knowledge proof?
Yeah, exactly. So like zero knowledge proofs, simply put, are the ability to prove something without having to see that thing. And so obviously that's my non-technical version of explaining what they do. But the infrastructure that we've built is slightly different. So generally, most zero knowledge proofs are like binary output. So is this unknown number greater than or less than 10? And you can prove that cryptographically, or you can prove a transaction happened as a binary thing, yes or no. And so that's the main implementation of zero knowledge proofs today. And it's not necessarily around privacy preserving computations in real time. And so what we do is we use our privacy preserving infrastructure, which uses trust execution environments and WebAssembly to do computations in real time of a particular borrower's risk, but doing it in a privacy preserving way. So ensuring that no one, including us, get to see that underlying data. But we can then do real-time computations on that data within this infrastructure. And then the proofs we produce are actually not proving something binary, but proving the characteristics of that process. So we prove that the process did happen privately, and that we only ran a specific set of functions and that we couldn't run any other functions using this particular hardware. And so borrowers can be sure that their data was only used in a particular way, and lenders can be sure that the data was computed upon exactly how they wanted it to be. So yeah, that's how we are leveraging privacy preserving technology to, I guess, solve 2 points. One is to have like a neutral arbitrator of someone's risk and to be able to do that continuously. And the second is this information asymmetry problem, which has been at the root of so much of what happened over the last 12 months, in that, generally speaking, maybe taking it a little bit further back, is that in traditional markets, credit underwriters and rating agencies are the trusted parties to provide a risk assessment on a particular borrower. And that isn't really evident in the space right now. And so what we find is that most of the lending happened based on trust. And that was because borrowers were very sensitive about the data that they had to share with a lender. So allowed bad acting borrowers to just rely on that trust and claim that actually they weren't very risky. And without someone in between as this trusted arbitrator of someone's creditworthiness, borrowers didn't really have to reveal anything because they could say, well, this is all very sensitive information, so we can't share it. And lenders ended up lending based on trust and not necessarily based on data. And so Credora is reimagining that intermediary in between, where you don't necessarily need to have a trusted intermediary like an S&P or a Moody's or an Equifax. You can rely on privacy preserving infrastructure where the borrower is sharing or validating their data and their risk, but without having to share any of that information with anyone. And so that's really the potential and benefit of privacy preserving technology.
Yeah, no, that's a very great way to kind of explain how ZK proofs relate to the DeFi world and whatnot. I think I was listening as I was learning and going down my crypto blockchain Web3 rabbit hole. There was a really good example about like how to apply ZK proof to like a real world type of situation, like something as simple as, let's say I have some cool new type of like QR code that people scan at the liquor store or, you know, another type of card, right? And instead of that person who is checking you out at the register seeing all your information, like where you live, your full name, like all that extra info, all they're able to really get out of that checkout is, okay, are they over the age of 21? So that's just another simply like put example of how zero knowledge proofs can kind of help our society be more efficient without, you know, giving away too much of your information. But that was
Yeah.
really, yeah, it was a really good example that I think people starting out in this journey and they're learning, that's a really easy way to kind of understand ZK proof or ZK knowledge or ZK rollups, whatever you want to call it. But moving on,
Yep.
can you tell us why credit, or like, I guess the biggest reason why credit is currently a problem and an issue in DeFi as well as CeFi?
Yeah. So generally, when loans are not collateralized, and so in the collateralized lending space in CeFi and DeFi, you have something that you can liquidate to be able to make whole on the loan when someone doesn't, meet their payments or their obligations. And so when you don't have that collateral, essentially what you need is some information on how risky a particular loan is and how that risk is changing. And that allows for more accurate deployment of funds, allows for better pricing of those loans, and of course, if possible, allows for secondary markets for that credit. And as I was mentioning, in traditional markets, you have some sort of, trendy word in DeFi is Oracle, but you have someone that you lean on for that credit score or credit underwriting. And there is some data that you can then point to say, hey, this is what the risk associated with this loan is. And then as a result, it should be priced X or Y. Now, because of this information asymmetry where borrowers aren't able to necessarily share enough information for lenders to be able to decide on the riskiness, a lot of what people have defaulted to is trust and relationships. And what that has obviously led to is bad decisions about where you should be deploying your assets. It's because they're not based on data, they're based on, or like thorough credit underwriting, they're based on a trust or an existing relationship where you're hoping that they're creditworthy because they've said they are. Now, we believe this technology, as I was saying, is super powerful is being able to get real-time data about these borrowers, but in a way where they feel comfortable sharing it because they know and they can prove that no one is seeing that particular data. And then what lenders get is a lot more information in terms of deciding, should I be lending to this borrower or that borrower, and what sort of rate should I be asking for? So really, it's trying to provide a basis for decision making in under collateralized lending decisions. And we have a lot of infrastructure both on chain and off chain to actually facilitate the transactions, but not necessarily a lot of infrastructure to give decision making power to the deployers of that capital. And you could do a lot more interesting things once you've also facilitated that initial loan, if you have a constant data source to be able to track how that credit worthiness is changing. So yeah, I think that's why we think that this is a really big problem right now. That is one of the main reasons why lending markets, under collateralized lending markets, have been quiet, is because at the moment lenders are looking for ways to get more comfortable with deploying again. And for that, they need data, they need monitoring, they need assurances that are backed by quantifiable data points.
No, that's great information. And I wanted to ask also, like, specifically, how does the borrower or lender benefit from the Credora model versus a competitor or other credit risk companies out there in the space?
Yeah, of course. So, I mean, if you look at, let's say first the lender side, what they get, or the structure of the market so far has basically been to have like a principal lending model, which basically is that you lend to some central intermediary, and that central intermediary gives you a small yield, and they'll go off and deploy it wherever they want. And, you just trust that they know what they're doing to be able to return your money plus that small yield. And what their whole game is that we're going to try and take a spread on this capital. So let's say you put your money at a bank and you get like 1% if you're lucky, and they are trusted to go off and lend it elsewhere and generate a higher yield. And let's say they go and make 5%. But we trust them because they're regulated, and we've just gotten used to trusting these banks. Obviously, a lot of what's happened over the last few years has made us question that trust, but generally speaking, we trust them. And the problem is magnified in like a nascent sector like crypto, where these principal lenders haven't been properly monitored or regulated. And so they can keep going further and further out the risk spectrum, where they lend with zero visibility into where those funds are going. And ultimately, they either make good decisions or bad decisions, but that's kind of pot luck depending on who you picked. And we think that principal model is a poorer option in these environments for a lender, where they benefit from a more transparent and open marketplace, which is what our platform Instant Lend is designed to be, where lenders can choose where they lend based on data, and then based on tracking that data in real time, so you can adjust your lending decisions going forwards. And you have the ability to track and see exactly where your funds are being deployed. So from a lender's perspective, essentially the benefit is they get a lot more data and a lot more optionality, and a lot more data to be able to make those decisions. From a borrower's perspective, really what we're doing is making it easy for them to be able to prove their creditworthiness without having to share their sensitive information. And so from a borrower's perspective, they're able to access a lot more lenders and prove their creditworthiness to a lot more lenders all in one place, without having to onboard with 20 different lenders and trying to negotiate the best possible rate. Here they can prove their creditworthiness through this infrastructure, and then be able to tap into all of those lenders and get the best possible rate, because they're able to validate their creditworthiness in real time and go through this thorough credit underwriting.
And earlier you mentioned a part of that onboarding are like risk metrics, correct? Could you share like examples of what you guys look out for What are those risk metrics, and how are they updated in real time on your platform?
Yeah, so essentially, when a borrower comes onto the platform and does a credit evaluation, there are a number of factors for any borrower that go into deciding how creditworthy they are. And our value add is that we can monitor a lot of these inputs in real time through this private infrastructure. So we can literally plug in via API to all of these borrowers' systems. So whether it's their bank account, their exchange accounts, their wallets, whether it's on-chain or off-chain, we can plug into it all. And we can do it in a way where they don't actually have to reveal that data to us. But we can do computations on that data that then prove whether it's what they say it is. And in traditional finance, or current way of doing the same sort of analysis, is by using financial statements or snapshots in time, where you look at, let's say, a financial statement and say, okay, well, in March, they had XYZ number of assets according to this PDF that they've sent. And you have to try and ascertain how true that PDF is, and you have to try and probe into, what might be being hidden in this particular financial statement, or what you might not be seeing in terms of risk. But it's a lot of trust and then establishing more and more evidence over time to see whether that snapshot in time was accurate. Instead, Credora is able to get real-time metrics, which can then immediately affect your score. So, we were monitoring borrowers throughout the most volatile period that crypto has ever seen, like throughout last year. And we could see in real time whether someone was being negatively affected by market events, whether they had money on FTX or not, and could immediately tell how that was going to affect their creditworthiness. And so for trading firms, it might be, like I said, concentration risk, or it might be directional exposure or leverage that they're taking that you can monitor in real time. For fintech, it might be their bank account balance, their loan book, or their SaaS platform. But you can pull this information in via API, and you can essentially validate the financial statements that they're submitting to us.
That sounds really cool and like super efficient. I'm just curious, like in terms of time turnaround of like, I guess, activating, whether it's a lender or a borrower, like how long does that process take to gather all those risk metrics and factors to be like, okay, yeah, they can be on the Credora platform?
Yeah, it varies from like whether that borrower fits into like an existing model that we have, or we need to develop a new one or plug into different sources. But it can take, there's like a standard KYC process, and then there's the process of them sharing all of their financial data and then us plugging into their accounts. So most of it, the delay is in the borrower doing what's required to be ready to be evaluated by our system. But generally that takes a few days, and then we can evaluate the data that's pulled in and be able to give an initial assessment, which the borrower can either approve or not.
Understood. And is the client's information stored on the Credora platform? And is the client able to customize what information is shared or not? Like, are they able to kind of have control over those settings?
Yeah, it's a great question. So Credora can pull private data from, like I said, any on-chain or off-chain source via API. But at that point, it's computed upon in this private infrastructure, and then only the summary metrics, so not the granular private data, only the summary metrics that the borrower has permissioned us to calculate are stored on secure servers. And then the borrower can permission who gets what of that data. So the borrower can selectively give permission to lenders about whether they share financials or real-time data or just a credit score, but they can choose what level of granularity they share with.
That's good to know. And can you tell us what happens in the event of a default?
Yeah, so generally speaking, Credora's metrics tend to give a very good indication in real time whether someone's creditworthiness is deteriorating rapidly or they're about to default. So a lot of that was proven out during the last 12 months where we had big market movements. We could see who was under pressure. And generally what that does is give lenders an indication that things are deteriorating and allows them to act based on those real-time insights. So a lot of the time we can allow lenders to be able to draw back or pull back loans before something has been triggered, such that they then have to go through a complicated bankruptcy process, and they can call back the loans much more effectively and quickly. And generally in these kind of events, the first person to call it back has the strongest hand. That said, like with any credit lending, there is always a risk of default. And we haven't had any defaults on our platform so far. We've facilitated over $1 billion of credit. But that being said, I'm sure there will be a default going forward, just given the nature of credit lending. But there is a standard legal process that varies from jurisdiction to jurisdiction and protocol to protocol. But they are able to use our platform to track where those assets are, and then also work with the relevant legal authorities to be able to stake their claim on the assets that they're owed. The idea is that we can give a lot more insight into where those assets are in the process in the event of a default.
Yeah, fingers crossed that you guys don't get any defaults, but you're right, it is what it is. But we can hope for the best, right? So, I mean, is there a quick way that you could maybe just explain to the audience, like, hey, if they are interested in joining the Credora platform, like, let's say I'm a borrower, and if I wanted to sign up today, can you walk us through the steps or approval process in a condensed version?
Yeah, of course. Yeah, so they can request access on our platform, credora.io. And once they're approved to access the platform, there is a simple KYC process for all borrowers. They have to submit their financials into our secure infrastructure, and then they can collect real-time API feeds. So whether that's an exchange API key, the wallet information, the bank account, but essentially we validate that those accounts belong to them through our automated processes. And then all of those three pieces combined are then used to put together a credit evaluation as well. And so then a borrower can then look at all the different protocols that use our scores and connect to them and be able to start borrowing through those protocols, or can look for other CeFi lenders on the platform and look to share their relevant metrics and look to borrow directly from them. The other thing that they can then do is also on our Instant Lend platform, post firm quotes about whether they have interest in borrowing, let's say Bitcoin at 5%. And then they can post that bid and wait for lenders to come in and hit that bid, and we will seamlessly settle those funds on the platform itself, and the borrower can draw those down, and essentially the lender will be able to monitor that in real time.
Incredible. Wow, thank you. Time flew by just learning about what you guys are doing over at Credora. And I just want to kind of leave some time to have you share. Is there like any upcoming plans that you guys are about to launch, or anything exciting that y'all are working on at this moment that you would like to share?
Yeah, of course. First, I want to say thanks so much for having me as well, and it's been a pleasure talking to you. As far as announcement our side, we just recently announced a strategic funding round that we closed, which was led by Coinbase and S&P, and we've also launched Instant Lend, which is our aggregated lending marketplace, which aggregates lending opportunities across CeFi and DeFi rails. So we're working with our partners in trying to bring more institutional capital into crypto and DeFi. So those partners include like Clearpool, Ribbon, Obligate, AlloyX, TrueFi, Atlendis, Sega, Idle Finance, and we've worked at Maple Pool delegates in the past. So we're looking to work with all of those to bring in more capital into the industry.
Wow, those are big names. That's amazing. And congratulations. Obviously, that's not everybody can, land those type of accounts, I would have to say. So wow, you must be really proud of yourself and the team.
No, we're very lucky, but thanks so much for the kind words. And yeah, I mean, I feel like we're just at the start, so we just have to just keep working hard, and hopefully we can add value.
Don't give up. Don't give up. Well, Once again, thank you, Darshan, for joining. Link to the Chain, BSOS, Andrew, and I at the team. Obviously, thank you for your time and contribution to the podcast, to educating anyone that's going down their own rabbit hole of Web3, blockchain, DeFi, RWAs, all that good stuff. And I can't wait to see what else y'all achieve in the future. So thank you again for spending some time with us today.
Thank you. Appreciate your time as well. Appreciate it.
Thanks.
Thank you.
With this, we come to the end of the episode. To our audience, thank you for listening. If you enjoyed what we are discussing about the RWA and DeFi world, please don't forget to subscribe to Link to the Chain and share it with others. To catch all the latest from us, you can follow our Instagram and Twitter at Link to the Chain. Looking forward to sharing with you guys the next episode. Stay tuned.